Hello and welcome to the Ecom Sales Tax Podcast. My name is Ryan Johnson and Dan Peisner. We got Dan Peisner back with us. Welcome, Dan.
Thank you, Ryan. I'm happy to be here.
I'm glad you're here. So I've been getting a lot of questions, and I'm sure you have too. We still get lots of questions about Wayfair. Wayfair is still a big thing for companies. Companies are still dealing with all of that. And a big question we get is, I have a past liability. I've got a lot more nexus in more states, and I have some past liabilities. What are my options?
Well, Ryan, the one of the most popular and long-running options is what's called a voluntary disclosure in most states. And what a voluntary disclosure simply is if you go to the state before they contact you and you let them know that you've been doing business, that you've had nexus for a period, and you request a voluntary disclosure, then usually the state will bring you into the program with a few provisions. They want you to get current on all of your taxes, so sales, income, and they will also want you to, usually they will want you to pay any of the tax that was due with either within since you had nexus or within what they call a limited look back, usually 3 to 4 years, with a couple of outliers there, whichever's less. So if you've only had nexus for a year, you're only going to report a year's worth of tax. If you've had nexus for 7 years, then you're going to get the 3 to 4 year limited look back. If you've had nexus for 10 years in Hawaii, you're paying all 10. Unfortunately, they don't know the meaning of a limited look back, and and one of the other things that they give you with that is they will waive, in just about all cases, they will waive penalty, and in some cases they will waive the interest. So you're on the hook for the tax, and in a lot of states the interest, and they may, in some states, even give you a reduced interest rate to help out a little bit. And so when we're looking at a client and we're advising they may want a voluntary disclosure, one of the things that we do is we look at their exposure, their overall liability, we look at their nexus, and we try to determine what the benefit of a voluntary disclosure would be. If they've only had Wayfair nexus, a limited look back is probably not going to help them. Wayfair only came about mid-2018, so they're already going to have less exposure than the look back in most states. And so we look to the penalty and interest savings, and if penalty and interest is going to be less than just paying the tax in, or I should say, if it's going to be less than our fees or the fees of some other preparer to do the voluntary disclosure, then oftentimes we may recommend against it. Although we've recently started looking at a final factor, and that is voluntary disclosures oftentimes will allow you to, for sales tax, just submit a spreadsheet and report your tax that way rather than back returns. And even in a few states do require back returns, but they usually let you do quarterly or annual returns, versus in the case of if I just went in and say Indiana registered for a sales tax permit, Indiana would likely make me file monthly returns going back to the date that I first indicated nexus. So if you're going back 3 years, you could be looking at having to complete 36 individual returns, which can take some time, and so that's kind of a third component we started looking at with these voluntary disclosures.
So a voluntary disclosure is really a negotiation between a state and a company. But how much can you really negotiate with the state? Do they have pretty set rules and regulations on what they are willing to negotiate, or can you negotiate quite a bit?
There's not a lot of room for negotiations. The way the states look at it a lot of the time is they're already giving you a break on the penalty, and they're already giving you a break on that tax. And so some of them are limited by statute to what they can do. Others are They may look at it on a case-by-case basis. One of the things you can sometimes negotiate on is the timing of the payment. So if you've got that liability, but you don't happen to have enough money sitting in the bank to pay the tax liability off, oftentimes you can couple it with some form of a payout plan or a payout agreement so that you're paying it out periodically, allowing you to keep your business open and still get the tax liability taken care of. And this can be important for any number of reasons. Some companies just have they have specific cash flow requirements, and while revenues might be sufficient, that you may have periodic revenue and they just don't have the money sitting right there, or you may, companies that are doing multiple states, they may not have sufficient cash flow to pay every one of them at once. So that can be another valuable tool in your toolbox when you're looking at VDAs, is the ability to do that staggered payout.
That is nice. I had another question. You had mentioned in the conversation we're having that, Texas has issued kind of a mandate that if you can work from home, work from home. And I'm assuming that, includes government workers. I mean, is this going to slow down? Because I know a VDA can take quite a bit of time, but will this slow down, the VDAs even more?
Absolutely. And I think that's something everybody needs to take into account for your dealings with the state governments right now. Is VDAs vary in time. Some you can get done within 45 days to 90 days. Some take 3 to 6 months to complete. And there can even be long intervals between when you hand in your last deliverable and then the state processes it and sends you a bill for remaining interest. And that's before any of the latest with the novel coronavirus running rampant. So picture that already delayed process now with a lot of workers having to work from home and not having the optimal facilities there. You're going to get a lot slower workflow, and we just expect everything with the states is going to slow down for at least in the short term and maybe even medium term, depending on how much things backlog. So if you have a specific deadline that you need to get your taxes resolved by, and we see this most commonly with companies being bought or sold with due diligence deadlines involved, and the parties are trying to make sure that any tax consequences are resolved. Start this early, because when the states are processing it, they do things on their own timeline. Sometimes you can get them to move you a little bit ahead, but if you've got a lot of people waiting in front of you in the queue, you don't want your business deal to kind of get delayed or torpedoed because you're waiting on the state to get you back a letter. So please take that into account when you're looking at this, and make sure you get any VDAs started nice and early.
Excellent. Thank you so much, Dan. And you heard it from him. If you know you have a past liability and you think VDA is on the table for you, please find our link down below, fill out the forms, schedule your free consultation, and let's get started on what needs to get done. All right, Dan, thank you so much for your time, and hope to see you on another one.
My pleasure.